What's going on, YouTube family? Welcome to Automotive Life. My name is Lucky, and today we're going to be talking about how the repo apocalypse or the auto loan crisis is getting even worse. So it's been about 3 months since I made a video talking about the auto loan crisis. And traditionally, I try to give you guys an update every maybe 30 to 45 days to let you know where the market stands. But unfortunately, as we move forward, it's very, very hard to get reliable data from this. I believe that banks are not really putting the information out there because they don't want people to know how bad it really is. Because if people know that there's auto loans crashing, people are giving back their cars, they're going to basically wait it out, and banks are going to lose millions of dollars in collateralized loans because they're going to take these things to the auction and lose a lot of money because people know that the market is turning. Now, with all that being said, I did find some reliable reports from Bankrate and bank.com about what's currently going on in the auto loan world. So let's go ahead and jump into it and look at some numbers. Let me grab my laptop. So first, I'm going to be talking about the prime customers, the people that have really good credit that got auto loans. Now, traditionally, these are the least riskiest amounts of borrowers. But what we saw during the pandemic was the perfect storm. So first, we're going to go over some numbers and then lead into why. So the numbers that came out in October of last year were stating that repos from prime customers went from 2% to 4%. Which a lot of people say that's not that bad, but in the scheme of things, remember, that is double the delinquencies, double the defaults of what they traditionally are at. Now, a lot of the reports that I read were saying it's hovering anywhere from 4.5% to 5.9%, almost 6%. So that just lets you know that people with good credit are starting to either, one, let their cars go because they can't afford them, or the other thing, people are actually walking away from their cars because they owe too much money on it. Now, there was this big Google trend thing, it hit the news, give back my car to the banks, and they've noticed that a lot of the voluntary repos that I go look at are people with good credit because they went out, bought a car, let's say a Corvette, they paid $30,000 over MSRP, and now they owe way more than what the car is actually worth. When today, they can walk into any Chevy dealership and pick one up at MSRP. So why are they going to eat all this negative equity? They're just going to go ahead and buy this other car and let this one go. And this is a trend that we're going to start to see unfold. Now let's talk a little bit about subprime. Now, subprime borrowers are traditionally the ones that have defaults. Now, subprime doesn't mean they're all bad credit. We're talking anywhere from like 590 to 695. So these are kind of middle in the pack, regular Americans. Majority of people fall into this range. So this next screenshot is showing how 60-day delinquencies have hit a new record high since 1996, which is about, I think it was 6.9%, almost 7%. So the reason why this is so significant is, remember, in 2008, we had the big financial crisis. Millions of people lost everything: homes, cars, credit, jobs, and unemployment was getting very high. Companies were shutting down and all that stuff. So think about this. Back then, we had massive amounts of basically everything falling out, and we still have more repos today. Now remember, the government's always saying that, our unemployment rate is very low. We're never going to have a bad economy because our unemployment rate is low. Now you can kind of see some of these things are not adding up. If there's the lowest amount of unemployment ever in history now, why are there so many people late on their car payments? Now, I just covered the automotive news. All my other friends that do finance, credit cards, delinquencies are all-time high. Mortgage, mortgage forbearance programs were at an all-time high, but people are not really late because they have equity. They wind up selling them. But credit cards, all this stuff, student loans, there are millions of loans out there that are currently late, not just auto loans. So just kind of let that sink in. Now, the next slide I'm going to show you, this is the one that I saw that really alarms me. The 90 days or more delinquency rate reached an all-time high. This is saying somewhere around 4% nationwide across the United States. Now, why is this number so significant? Because as you can see, if they're 60 days late, they're averaging around 7%. Why is this 3.91% so intriguing? The reason is because banks traditionally, once you start being late, once you hit 30 days, they put you on a basically nonstop call list. After that, once you hit day 45, they put you out for what's called pre-repo. They look at your past payments, they look at your information to see if there's something that's happening, and then they go into negotiations with you, like, can you make payment plans? Can you do something? Or if they see that there's no way out of this, they start basically lining up your repo. So by day 60, your car's already basically sent, they're tracking you, they're going after you, they're picking up your car. But if we have record amounts of 90 days or plus more late, that means that there are so many people out there with cars that are not being repoed. And so one of the things that I really wanted to report about today is the fact that banks are not picking up cars aggressively as they should. Now, I've talked to multiple banks, and I'm going to go to NADA to talk to a few more, and they're basically telling me that they are so afraid of taking big hits when they take these cars to the auction. The NFL playoffs have finally arrived. And to add excitement to the game, our sponsor, Underdog Fantasy, is stepping up. Underdog Fantasy is the easiest place to play fantasy sports. Just pick high or low on your favorite player's stats and you could win big money. It's simple. Pick between 2 and 5 players in a build and pick 'em entry.
Get up to 20 times your money on a single game.
Underdog is now available in 30 plus states, including California, Texas, and even Canada. Check the pick'em eligibility map on the screen to see if you fit in. Now with the NFL Conference Championships on this Sunday, I like Detroit Lions with Jared Goff. Now you can pair that with Christian McCaffrey and all you have to do is go over 1 total yard. That's right, all you have to do is get 1 yard and you win. Now here's the best part. When you use my promo code LUCKY, Underdog will double your first deposit up to $100. That's Underdog Fantasy, promo code LUCKY. This is the easiest way to make money on Underdog. So make sure you sign up with my promo code LUCKY and Underdog will double your first deposit up to $100. I want to thank Underdog so much for sponsoring this video. Let's get back into it. Now these big hits that banks are worried about are called deficiencies. When they sell a vehicle at auction, let's say the loan is $40,000, but the car is really worth $30,000 at the auction. A dealer like myself will come bid $30,000 for that car, and when I buy it, that $10,000 discrepancy or deficiency, the bank has to eat. Now, everybody watching this says, well, it doesn't matter, the banks are gonna write it off. It doesn't work that way. They need to put on their books a certain amount of money flowing through. So it helps them to basically not take these big hits right away. Now, what they're trying to do now is push that can or kick the can further down the road. They're offering more payment programs. They're offering deficiencies. Some banks are literally stopping your payments, giving you basically forgiveness for 90 days, and then starting them back up and adding those payments to the end of the loan. So now people are basically given these free 90 days just out of the blue. And what the banks are trying to do is they're hoping that if they don't ruin their customers' credit and they're still paying, eventually they'll be able to either sell or refinance the car. Plus the banks won't have to take that major of a hit on their books. Now, I've never ever seen this happen before in my life. Banks traditionally want to get that car and get it back quickly. Even during the 2008 fallout, that's when I got the most cars I think I've ever gotten. Now, there are definitely 2 sides of the coin. I have one bank that I'm going to be showing you guys on Monday. I just got a bunch of repos. They're being aggressive. They're not waiting for anybody. They're tired of chasing people. They're just taking everything and just auctioning it off for whatever because they just want to close the books on their auto loans. And they're going to stop lending here in the state of Nevada because they don't want to deal with the headaches. But you have other banks and major banks actually saying, you know what, we want to pump the brakes. We don't want to repo the cars. Let's just give these people more time so our books will look better. We can kick the can further down the road. And as we have to report these numbers, like the ones I showed you earlier, they can show that they're actually making money or doing not so bad. Because I honestly believe if they were super aggressive, like some of these other smaller banks that didn't have billions of dollars to lend, I'm sure they'd be so crazy that the numbers would pretty much be double than what they are right now. Now, if you don't believe me how bad the market is, just go to Facebook Marketplace and look how out of touch people are. And you can see this a lot in people's stuff. Put like have a loan or IO or something like that in the title search, and you will see all these people trying to sell their cars for what they owe. And unfortunately, what they owe is absolutely ridiculous numbers. Now, here's the problem that we're having, and this is what kind of feeds back to this self-reciprocating system that's basically crushing the auto market and how the auto loan crisis is going to get worse. When they buy a car, like I said, during the pandemic, they overpaid. So what do they do now? Most Americans will go in every 2 to 3 years to buy a new car. So guess what? All the clowns that paid way over in 2020 and 2021 are now all trading in their cars, trying to get the new latest thing. And when they bring them into the dealership, they're getting offered 60 to 50% of what they purchased it for back at the height of the auto market. So now these people have these cars that they can't get rid of. They can't get new cars, so they're stuck with their old cars. What happens if they're like at maybe 20%? Because a lot of people got crazy loans during the pandemic that should have never got these loans, but they got them anyway. So now they're like, well, I'm going to go ahead and refinance it. Well, guess what? You can't because you owe more money on the car than what it's worth. Most banks will not let you refinance it. So now they're stuck with whatever payment they got. They can't stretch it out to maybe lower their bills so this way they can maybe save some money. They can't do anything. They're pretty much screwed. Their only options are 1, to basically give it back to the bank, 2, pay it off, Or three, which is crazy, which is also raising insurance prices, they're either crashing them or reporting them stolen. You can look on another thing. It was a National Insurance Crime Bureau, like thefts and basically insurance fraud is also at a record high because people are trying to get themselves out of this crazy debt. Now, as we start to basically do this death spiral in the auto loan world, what's going to happen, how this is going to affect you is every time a car gets basically repoed and they lose big chunks of money, that information goes into a database. And what this database does is it tells the bank which cars to lend on and how much. And this is what sets the precedent for what's going to bring the auto prices down. Because now if they were giving out loans for $60,000 for a Jeep Wrangler and now they can only get 40 grand at the auction, guess what? Their next batch of loans is going to be $40,000 and below. So if you're out there in the market trying to buy maybe a really nice Jeep and it's $55,000 and the bank comes back saying, you know, we're only going to approve you for 45, not a dollar more. Now you have to come up with that money out of their pocket. And unfortunately right now, once again, another thing that's an all-time high is low savings rates. Americans don't have the money to put the big down payments. Also, their credit cards are maxed out because credit card debt's at an all-time high. So how are these people going to put these big down payments on overpriced cars to get a high interest loan? Because the average used car interest is 11.9%. New cars is hovering somewhere around 7.5 and 8.5%. So nothing really spells out you're going to save money and you're going to be able to move more cars. Now, as these things start to roll out, you're starting to see dealers basically panic as well as the banks because they know that the gravy train is over. It's time to pay the piper. All the shitty deals they did to people, how they buried people in these cars, it's all coming back to haunt them. And once again, I have to say this because like I said, on this channel, we want to be transparent. None of this could have been possible without you. That's right, the consumer. Because remember, nobody will force you or put a gun to your head to sign this paperwork. If you bought a car that's way overpriced and you're upside down, unfortunately, you have to take some of the blame, which is fine. We all make mistakes. But hopefully you learned a little bit in this video and we can move forward and get you a better deal. Now, here's what you need to do if you're going to go forward and you're going to buy a car in 2024. First, figure out what your DTI is, your debt to income ratio. Traditionally, banks didn't care about this because they were just giving loans to everybody. But now I'm seeing banks really tighten down with that credit crunch because they don't want to lend out more than what they have to. So if a bank says they're only giving you a 30% DTI of whatever your payment is to your income, you have to figure out exactly what that is and then buy accordingly. Know how much money you're going to have to put down on the car, what the limit of the amount you could finance, all that fun stuff. Also, if you are, let's say, self-employed, you need to have bank statements, W-2s, tax returns. They're going to want all this stuff if you are self-employed because if not, you can't go in there just saying you make, $200,000 a year, you're a baller, you're a business owner, entrepreneur. That shit doesn't cut anymore. They want paper and documents, and they will call your bank or use Plaid to sync to it to make sure that you're not defrauding them. If you're a regular person, you have a job, guess what? Same thing for you. They're going to not only check with your employer, they're going to check your pay stubs, and some of these people are going to use LexisNexis to check your tax returns just to make sure that you're you and you're reporting the true numbers because these banks don't want to basically get penalized lending out money to people that really can't afford it. Now, banks have two sides of the coin they get punished by. They have their investors and their shareholders where they got to produce a certain amount of profit, but also some of these banks have certain lending criteria where if they get too aggressive with funding or they give somebody too much money that they shouldn't have got it and they basically default, now they go into what's called predatory lending. And this is where they get fined millions of dollars. Wells Fargo, I think, got fined $13 million for basically predatory lending when it came to auto loans. So this is not something new. It's going to be happening very, very soon. And it's already unfolding in front of us as we speak. So what do you guys think of the current state of the market and the auto loan crisis? Do you know people that are having their cars repoed? Have you seen your neighbor's car repoed? Are you starting to see people basically put up their cars? Because I know a lot of people bought 2-3 cars during the pandemic when we're bragging. Now they're all starting to sell them. I'm seeing the biggest hits in the luxury sector, but what are you guys seeing in your market? Regular cars going down, exotic cars, cheap cars? Let me know. Also, if you could do me a huge favor, please like and subscribe. It means a lot to me. It helps me with the YouTube algorithm find amazing people like yourselves that enjoy automotive content. And even if your opinion is different from mine, that's okay. We can still be friends. The whole purpose of this channel is to be transparent about the automotive industry. But I want to thank you guys so much again for watching. Follow me on Instagram at Lucky Lopez. Oh, also shout out to Underdog Fantasy, and I hope Detroit wins this weekend.